Hey guys, this is Aperture, and in this video I'm going to show you how to use the Stochastic RSI. I use the Stochastic RSI when I trade trends to catch the next wave up. This video is sponsored by Crypto.com, the only single exchange that allows you to trade more than 200 pairs with up to 10x leverage and trade more than 40 quarterly futures and perpetual contracts. On top of that, you can earn daily rewards on your balance with no lockup period. Purchase newly listed tokens at up to 50% off. Check out the description of this video and earn $50 USD worth of CRO using the link below. Okay, let's take a look at the Stochastic RSI. I have it on the screen here, but you can add it by using the indicator menu here and typing in Stochastic RSI. And don't use the normal Stochastic. This webinar is about Stochastic RSI. But I will add the Stochastic and I will also add the RSI. The normal relative strength index. So we have all of them here at the bottom of the screen. The top one is the Stochastic RSI. This one in the middle is the just normal Stochastic. And at the bottom, there's the RSI. So let's start with what these indicators are by calculation. And then I'm going to move forward to the part where I will talk about how the Stochastic RSI can provide signals and maybe the general idea about using it. And then I'll give some specific examples. But let's start by looking at the Stochastic RSI. You can always see what a Stochastic RSI does or any other indicator by clicking on the source code. And even if you don't really know how to write this code in TradingView, it will give you an idea of what's happening in TradingView. So you click on the source code button in that indicator menu and you'll get some code. I think the most important part is the K and the D calculation, because the Stochastic RSI has two lines. It has the blue one, that's the K, and the second one, it's the D. And basically the blue line, so over here in the menu, you can see that the blue line is the K, is the signal line, and D is the lagging line. What does the calculation do? Basically, the K, so the blue line, is a moving average of a stochastic indicator of the RSI. So it's actually a calculation of a calculation of a calculation. If you can't view this code, try to just open it in your TradingView itself. It might not be super clear if your screen is a little bit smaller. But you can view the calculation itself. But it isn't about the calculation. I'll just tell you what it does. So the K line is a stochastic of the RSI, and then it smooths it a little bit with a moving average. Always, if you see a moving average calculation, it's all about smoothing and removing some of that noise. So that's the K line. And what it basically does is it calculates like this stochastic RSI, which normally is calculated by putting in the close, high, low, but now it calculates it based on the RSI itself. So you have a stochastic indicator that's being calculated on a momentum indicator like the RSI. And that creates one line, the blue line. Then if you look at the code, you can see that the D line is basically another moving average from that K. So these two lines, one is the calculation, the other is a moving average of that calculation. And this is where it becomes interesting, because you create a momentum indicator from a momentum indicator, because the stochastic and the RSI are both momentum. But the stochastic takes into account that the market moves in waves. And maybe if we look at the chart a little bit and make these indicators a little bit smaller, what it tries to do, the stochastic, is see where the market tries to move in waves like this and tries to give like a signal where it starts to move up again, which is also what the RSI does if you put that stochastic on it, funnily enough. But it smooths it out a little bit more. As you can see, it gives a much cleaner signal and a much cleaner chart here. Why is that? I think it's mainly because if you just put in prices, price information like the close, the lows, and the highs, that's where it can be really noisy because it calculates it based on every candle. What the RSI does, since it is a momentum indicator, it tries to catch that general trend. And as you can see here, RSI is up and trend is up. So it shows that momentum in the RSI indicator too. And by adding a stochastic on top of that, you'll try to find some of these waves inside the RSI calculation. And that would only normally result in the blue line, but by adding that second line, the orange one, that's where you add a signal. So always if you have a signal line, it's often a moving average. So remember that principle of that moving average crossover, where if one slower moving average, so a longer period moving average, is being crossed by a faster moving one, so a shorter period moving average, that's when there is momentum. So basically, the stochastic RSI measures in that momentum some momentum, and it basically makes it go, makes it show an indicator that catches these waves. And this is what I want to, why I like using the stochastic RSI itself, is because in general, a market doesn't move in a straight line up. We could try to fit some line in here around which it moves, but the market always moves in waves around a average. And you could also add a moving average, for example, to get an average price. Let's pick maybe the 20 over here, which you will see also is around that line. Maybe we could find a line, fit that line a little bit better based on that moving average. So we have some kind of model of price around which price on average fluctuates. So we can look for optimal entries in the trend, because in trend trading, we like to assume that trend is continuing. And that's a very important principle in crypto. Once there is a trend, it probably continues. As you can see here, it's going sideways, not really a trend, maybe a little bit like this. But as you can see, you could still short this a little bit for some profit. Of course, uptrends in crypto are more special, and often they are more aggressive than downtrends. Downtrends just tend to bleed, while uptrends tend to move fast and have some impulses and a lot of hype around it. Basically, you'll try to catch that hype or that longer period interest in the market by trying to get in the trend. So once we identify the trend, a line like this, even if it's over here, we could look for an entry, because we have that assumption that there could be a moment where trend continues again. And because we know the market doesn't go in a straight line up but in waves, we could try to catch a bottom of the wave, like somewhere over here or somewhere over here, or maybe in the future. And I think that's where the stochastic RSI is really great, because in these waves you have moments of momentum, like over here, and you can see that stochastic RSI going up. And then you have periods of lower momentum, and then you can see that stochastic RSI resets. And when the momentum finally picks up again, that's where that stochastic RSI crosses. So here's that moment where the momentum picks up, and here's that momentum also showing in that stochastic RSI. And that's really amazing, because you get a signal that trend is continuing after a pullback. Because the problem with this is that you might never be sure when the pullback happened. Price could move in waves, and maybe the correction will be deeper until it continues. So the stochastic RSI gives us a reason to enter the trend again, because probably it at least resets, like the momentum is reset in the trend. It's back to that average line or around that average line, and we can catch that next wave up.